Welcome to Sophie Daddy's channel. We're about to dive deep into the wild, unpredictable world of financial markets. You know, at first glance, it all looks like pure chaos. But what if I told you there's a hidden pulse, a rhythm that the pros actually use to try and predict what's coming next? Today, we're going to explore the amazing tools they use, from old-school statistics all the way to cutting-edge AI.
So let's just start with a really powerful question. What if you could see a market storm coming before it actually hits? And look, this isn't just about getting rich. For the professionals, this is about survival. It's about managing risk and just trying to make some sense out of all that uncertainty.
So how in the world do they do it? You might think it's all about predicting if the stock is going to go up or down, but honestly, that's a bit of a fool's game. Instead, the real pros focus all of their energy and resources on forecasting one single hidden variable, volatility. Trust me, understanding this is the key to everything else.
So what exactly is this hidden pulse? The best way to think about it is as the market's mood. You know, sometimes it's totally calm and steady, and other times its heart is just racing, totally erratic. So if you want to predict the future, you first have to figure out how to measure that pulse.
Okay, so the formal definition is that volatility is just the size of the price swings. Big swings mean high volatility. Tiny swings, well, that's low volatility. Simple enough? But here's the tricky part. Unlike a stock price, you can't just look up the current volatility on your screen. It's a hidden value. It has to be estimated.
We basically measure this pulse in two main ways. First, you've got your backward-looking or realized volatility. This is just calculated from prices in the past. It tells us what the market's mood was. Then there's the forward-looking or implied volatility. This one's really cool. It's pulled from options prices, and it's basically the market's own forecast of what its mood is gonna be.
But wait a second, why should we even believe that volatility is predictable at all? The answer is in this really fascinating property that financial markets have, and it's known as volatility clustering. This one simple observation, it's the bedrock of literally every single forecasting model we are about to talk about.
So to put it simply, market moods are sticky, you know? Calm periods tend to be followed by more calm, and those really stressful, chaotic periods, well, they tend to be followed by more chaos. It's this persistence that makes forecasting possible in the first place.
All right, so how do we actually model this clustering behavior? Well, the first huge breakthrough came from a classic tool that absolutely revolutionized risk management.
And this tool is called the GARCH model. I want you to think of it like a weather barometer, but for the market. It uses today's conditions, so specifically the size of today's price shock and the current level of turbulence, to forecast tomorrow's market weather.
Now, the logic behind GARCH, it's not some kind of magic. It's actually a pretty elegant process. It starts with a baseline, you know, the market's long-term average mood. Then it reacts, adjusting for how big yesterday's shock was. And finally, it accounts for that stickiness we talked about by adding momentum from yesterday's volatility. It's really just a simple blend of these three things.
The standard GARCH model is super powerful, but it makes one really big assumption, that the market reacts the exact same way to good news and bad news. But is that really true? Does a surprise 5% rally create the same level of future jitters as a surprise 5% crash? In the real world, the answer is a definite no. And this is because of something called the leverage effect. I mean, let's be real. Fear is a much more powerful emotion than greed, right? So bad news, a negative shock, cranks up future volatility way more than good news of the same size. That's why more advanced models were developed to capture this exact asymmetry, which makes them a much more realistic barometer.
The GARCH model is powerful, for sure, but it's based on a fixed theory. What if, instead, we could just let the data speak for itself? This is what brings us from that classic barometer to the modern supercomputer, the world of machine learning.
This new arsenal uses a completely different philosophy. For example, you have neural networks like LSTMs that are designed to actually remember market patterns over long periods. Then there are other models like XGBoost that are just absolute powerhouses at finding super complex relationships in the data. And their biggest advantage? They can look way beyond just past prices. They can analyze thousands of variables, from economic reports to news sentiment, all to find an edge.
So this brings us to a really fundamental trade-off. GARCH is transparent. You can easily see why it's making a forecast. Machine learning models, on the other hand, are often more accurate, but they can be black boxes. It's like a brilliant chef who cooks an incredible meal but just won't share the recipe. They give you the amazing result, but not the reasoning. So it's this classic battle between simplicity and power. Now, this isn't just some academic debate. On modern trading floors, these forecasts are being used every single second for two main reasons: playing defense and playing offense.
Okay, first, let's talk defense. In this case, a volatility forecast acts like a shield. Its main job is just to protect a portfolio from getting totally wiped out when the market suddenly decides to go wild. And this shield works in a few ways. It lets firms estimate their maximum potential loss using a metric called value at risk. It tells trading algorithms when to automatically scale back their positions, kind of like a ship shortening its sails when a storm is coming. And it helps set smarter stop losses that don't get accidentally triggered by random noise. It's all about survival. But these forecasts can also be used as a sword. See, in the world of options and derivatives, volatility isn't just a risk you have to manage. It's actually an asset you can trade, which creates all kinds of opportunities for profit. What this means is you can actively bet on which way volatility is headed. If your model says chop your C's are ahead than the rest of the market thinks, you can buy options. If you predict calmer weather is coming, you can sell them. It's a direct bet that your forecast is better than the market's collective wisdom.
But here comes the reality check. No model is a crystal ball. It doesn't matter how advanced it is, every single forecasting tool out there has a fundamental, inescapable blind spot. And that blind spot has a name: the black swan. This is an event that is so rare and so impactful that it's just beyond the realm of normal expectations. It's the thing you never, ever saw coming, because it has never shown up in the historical data before. Think about the 2008 financial crisis, or the sudden start of a global pandemic. You see, all of these models, from the simplest GARCH to the most complex AI, they all learn from the past to predict the future. This means they can react to a black swan, so they can forecast extreme volatility the day after a crash, but they can never, ever anticipate the black swan itself. By definition, it's an event they've never seen before.
And this brings us to our final and maybe most important question. If a perfect crystal ball is just impossible, and even our best models can be blindsided by the most important events, then what is the true value of making a forecast at all? Perhaps the goal isn't perfect prediction. Perhaps it's about building systems that are resilient enough to survive the unpredictable. Maybe the forecast isn't a guarantee, but simply our best available map for navigating a future that will always, always remain uncertain.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.